I actually think it's even worse than we've just heard. So she knew for 10 days or so that she didn't need to put income tax up. So it's not economics that has changed her mind, it's politics.
Don't fall off your seats here. I am no longer a bear. When I do go bullish, so not to be a rabbit stuck in the headlights, I am now changing and I am buying into the potential for a Santa rally.
I'm totally aligned with Rich. Is that the true end of the bull market?
Friday will be when the OBR sends to the Chancellor their last forecast before the budget itself. So she can't change her mind now. She has decided everything that she's going to do.
He's been waiting for this his whole life.
Right, here, sorry, Chancellor Fellingham, here we go. I'm not doing this little bit about, I'm cutting national insurance. I'm putting income tax up by 2p.
The first red card of the series. It will be very well cheered. Your capital is at risk. The value of your shares, ETFs and ETCs can fall as well as rise, which could mean getting back less than you originally put in. This content is for information purposes only and is not investment advice. Past performance is not an indication of future results. Welcome to episode 20 of the UK's top financial podcast, The Art of Investing. This week, we bring you a pre-budget special. So introducing the Speaker of the House, Mr. Chris CJ Fellingham.
Hey!
Order. And eyes to the right, it is Leader of the Opposition, Mark Spice Holden.
Yeah.
Joining us today, a very special guest, the former Chief of Staff to the Chancellor, and going to help us pull back the curtain on all the secrets of this budget special, it is Adam Smith.
Thank you for having me. Yes, I was a former Chief of Staff to Jeremy Hunt when he was Chancellor of the Exchequer. So I was his main political and economic advisor. I oversaw 2 budgets and 2 autumn statements. Since leaving the Treasury, I've set up my own business, advising companies on tax and economic policy, and I write in The Telegraph on economics and politics.
So many stories to come about certain budgets that you've been involved in the past. But first, we are going to go to the Spice Market Update.
Just hold on a second, Rich. Hold on a second. What I wanted to talk about was the fact that we need to make a shameless appeal for your vote, you, the listener, to vote for us in the Good Money Guide Awards for Best Financial Podcast. Woo. The fact that we have got this chance is a wonderful, wonderful thing for us. And I would encourage everybody to look up the show notes, look at how you vote for us, and please vote and express your wish for us to be the best financial podcast in the UK.
As we already know.
Thank you. Over to you, Mark.
Thank you very much. Well, it's been another brutal week for cryptocurrencies, led by Bitcoin, down over 10% this week alone. It's now down 35% from its recent highs. That is basically a crash, as we would term. You remember our terminology about markets falling. And yesterday saw the biggest single daily withdrawal from one of the biggest Bitcoin ETFs in the world, the iShares Bitcoin Trust, which is run by BlackRock. They saw $500 million worth of withdrawals. That's, let's say, the biggest ever. Maybe that marks the bottom. I don't know. We've got an expert around the table. What do you think, Chris?
I think it's really quite tricky. I mean, we've been talking about it for the last few weeks and how this is a deleveraging essentially going on. Crypto's about borrowing and lending and borrowing and lending, and people go over their skis, they get too risky, and then suddenly they come back to earth fairly quickly. Big step back. You've got to think that if it's just that deleveraging, we've got to be close to those levels to buy it. I suppose the only issue for me is that when crypto has gone into a bear move before, it tends to fall by 60 to 80%. So, there is considerable downside if it is that bear move. I don't think it is the bear move. I can't see any particular reason as to why now would be a bear move. We've seen some rowing back in expectations for what's going to happen to interest rates in America. And Mark will talk a bit more about that in a moment.
Absolutely. Well, you rightly said, Chris, Equities have been hit at the margin as well. We've had a dip, which remember a dip in equities is a fall of between 3 and 5% this week in both the S&P 500 and NASDAQ. And they'd been, obviously been riding very high until the last couple of weeks. But part of the reason for that is probably people having to make margin calls or raise money to pay for some of the crypto losses. But also we've seen a sort of almost a concerted effort by the several members of the Federal Reserve in the United States talking down the chances of an interest rate cut in December. Now, just 2 weeks ago, there was a 70% probability of a 0.25% cut at the next Federal Reserve meeting, which is on the 10th of December. That has now fallen to 30%. It's been pretty brutal. There's been 2 or 3, like say, high-profile Federal Reserve members talking about it. But another reason for that is that the jobs data, if you remember, because of the government shutdown in America, there's been no data coming out. And this Federal Reserve say that they are data dependent. So they need to look at data before they make a decision. So they make it after, a supposedly informed decision with the data in front of them. But because of the government shutdown, the jobs report, which is one of the big components of their interest rate making decisions, because they have a dual mandate. Remember, they don't just have to worry about inflation, they also have to worry about trying to get full employment. The jobs report for September is coming out this afternoon, which is Thursday today. But then we're not going to get an October or November report until a week after the Federal Reserve meeting on the 10th of December. So the next data won't be until after their meeting. So most of these Fed officials are saying, well, without that data, we can't make an informed decision. Therefore, we are unlikely to make any changes. And that's why the market has moved so aggressively. That has obviously, at the margin, impacted equity risks. That was until, I have to say, last night.
Here he is.
The bull's back.
There we go.
The bull is
Here we
back,
go.
snorting away.
Thank you very much, Jensen Huang, for basically delivering a fantastic set of results from Nvidia. I have to say, I don't think I've ever seen such an amazing set of results from any company, let alone the biggest company in the world.
The guidance was just mind-blowing.
Absolutely. I mean, they said basically they've sold out of all cloud GPUs. And basically, so they were saying that the demand for their latest chips, Blackwell, is nowhere near slowing. In fact, it's growing exponentially. Now, we've had debates about what exponentially means in this podcast before, Rich, haven't we? But they're saying basically it's growing off the scales. It's amazing. And their margins as well, the money they're making on them is going up, not down. So they're selling them at more profit. So their gross margin has been going up. So basically that is the price they get for selling the product, the cost of it taken away is about 73.6% in this last quarter. And that's expected to rise to 75% next quarter, so in the fourth quarter.
And she even said on the conference call that it's going to stay there next year when the revenue guidance, and it's just,
it's amazing. All the metrics are just going ballistic. So hats off to them. And it has led to a very decent turnaround in some of the markets, particularly NASDAQ, which has the biggest exposure to it, and the S&P 500. So by the time this podcast comes out tomorrow, they might have seen a bit of a recovery in some of these markets, if that holds.
And our portfolio. Not to give any insight into it.
We will be talking about that, I'm sure. Elsewhere, it's been an interesting week. Some big announcements coming out of America. As we know, AI is very, very power hungry. And yesterday, the United States announced that they're going to start building 10 new large nuclear power reactors. So that is principally to power the AI data centers and that boom that's coming. And funny enough, it's being funded largely by Japan and the deal they did on the tariffs. So Japan, remember, have pledged $550 billion to help America. And that part of that money looks like it's going to be spent on these nuclear power reactors.
And the rest on the banquet hall in the White House.
Yes. Well, not the Federal Reserve can't do that, can they? We're talking quite a lot in this podcast about the potential impact on employment or unemployment of AI and the efficiencies that will bring, the productivity gains it will bring, and that will lead to some layoffs in staff. I noticed that the New York State in America now make it mandatory that any company that's laying off workers, any company with a turnover of more than $1 million, have to specify why those jobs are being laid off and if they are AI related. Now, that's the first state to do it in America. I'm sure that actually others will follow, because I think it's quite a good thing for you to do, to say exactly why you're laying off workers. And if it is AI related, then the sooner we know about it, the better, I think. And so that was an interesting development for me. We'll see how that goes. So one of the things that I noticed this week that made me think that perhaps the froth had been taken out of this AI supposed bubble that's out there was the fact that Oracle, which if you remember about 5 or 6 weeks ago, rose about 40% in just a few days on the back of their results and their deal with OpenAI. Basically, the shares had retraced all of that gain in the last 5 or 6 weeks. And as of yesterday morning, they were trading at a lower share price they were than before they started to make that move higher, which is quite incredible. And that was a very positive sign for me that actually valuations have come back into sensible territory.
There was a valuation done on that deal as well. So it was meant to be worth $300 billion. And apparently now, because of the movement in the CDS and the debt, it's now valued at a net present value of minus $24 billion. So that tells you about where we are with the feeling on Oracle at the moment. And I must admit, I did pick up some of the stock this week because, don't fall off your seats here, I am no longer a bear.
Whoa!
I am officially going to enjoy eating this afternoon because I think we've now had enough of the froth coming off the top. We've had a 60% drop in quantum stocks. We've had a 50% drop in the rare earth stocks. We've seen every sector of the market that was just wild speculation, including the VanEck crypto and blockchain ETF.
Thank God we sold a chunk of that.
Yes.
But we're still trying to play connoisseurs for those who remember last week's episode.
Oh, yes. So not to be a rabbit stuck in the headlights, I am now changing and I am buying into the potential for a Santa rally. And when it comes to the portfolio changes, I may not put as much resistance to Mark's ideas as I have done previously.
Well, look, there's a couple of things from my side of the fence that I think it's worth thinking about this week. The first one, a bit of a quiz for you, right? So, get your thinking caps on. I'm going to say some phrases to you, and I want you to guess, who I am and when I said this. When I was appointed Chancellor, people put their faith in me to take our country forward, not to be swayed by political convenience, not to always do what is popular, but to do what is right.
Gordon Brown.
Oh, right, so that's a good try. But no, next one. At the budget last year, I fixed the foundations. If we are to build the future of Britain together, we will all have to contribute to that effort. Now, the reason why I'm asking you who it was is because clearly the person who'd said it literally 2 weeks ago in an unprecedented 8:15 speech with the assembled world press forgot what she said. Because now, on last Friday, leaked through the great offices of the Financial Times, but then through the BBC, we're not going to raise income tax now in the UK. We don't need to do that, having prepared us all for it. That has just destroyed any little credibility this Labour government had. I feel very disappointed about it because, as most people know, I'm an optimist. I try to look on the right side. I've been trying to think that this government that we have in are going to do the right thing. And each time they let me down. And every time I think they can't let me down anymore, they let me down again. And here's a perfect example of them saying one thing and being scared of doing it, not sticking to the courage of their convictions and getting put off it. We are now in a crisis, in my view, just as serious as Liz Truss in 2022. Now, you're all going to be laughing at me. People listening, they're going to say, yeah, can't be right. Mortgage rates haven't soared up and the infamous lettuce hasn't appeared yet. But yet is the operative word, because at least with the Tories, they could get rid of Liz Truss and replace her with some sort of grown-up. The alternative to Starman Reeves is not someone who's going to get more grown up. We've seen the decision they made last week not to raise income tax is one of the worst decisions the government could make, having set people up and told them that they were going to do it. And the markets, unfortunately, notice it. And the problem is for them that long gilts last Friday and now yesterday as well, but over the last 3 or 4 days, have moved up by 30 basis points from 5.15 about to 5.45, almost up to the highs that we had 2 or 3 months ago.
I think it's worth explaining, isn't it? That move is equivalent to 0.3% of an interest rate rise, isn't it?
it's a large amount. It's not a rise that you would expect to see in the normal course of events by just the normal move in markets. That's clearly telling you the market is losing faith in their ability to make the tough decisions. So now we look forward to a budget next week, and short of massive cuts in public spending or returning to those income tax rises, it's difficult for me to see how you get a case of long gilt yields falling. And remember, if long gilt yields rise, it means that when we come to fund our deficit, it gets more and more expensive. What it's saying is, if you want me to buy your long-dated debt, I need a bigger risk premium because I can't trust that you're going to carry on doing the right things.
CJ, I think you must have been reading the same Telegraph article that I did this. So you really it all but put the final nail in the coffin of Rachel Reeves and talked about even the potential of her being replaced in January. Adam, I wonder, did you see the same Telegraph article?
Possibly, yes, given that I wrote it. And I think not wanting to be the bearer of even worse news is that I actually think it's even worse than we've just heard, because the reasons that we were given for Rachel Reeves changing her mind was that apparently she got some new forecasts from the OBR saying she didn't need to raise income tax. Things weren't quite as bad as we had previously thought. But the problem with that explanation is that if you look at the published timetable of when she would have got that forecast, she actually got it on the 31st of October. So she knew for 10 days or so that she didn't need to put income tax up. So it's not economics that has changed her mind, it's politics. And the thing is that the markets will completely see through that, and so will the public. And she's now in the position where she's basically taken all the political pain. The people know she was happy to break her promise to put income tax up, but she's getting none of the economic benefits. So I think her credibility is completely gone, and the Prime Minister will no doubt see that. The only reason why she's still in the job is that you couldn't expect somebody to come in now and give a budget this close. So I think he will inevitably have to do some sort of reset politically in the new year, and I think he will have to appoint a new Chancellor in the new year, and that will actually be even worse than we have now.
That's the point. To me, any uncertainty creates more uncertainty now. And the fact that people can't rely upon what was being said builds in that risk premium, makes it more expensive for the government to borrow and hurts us all as citizens of this great country. So I was very, very depressed when I saw that come out. And that has meant that, to me, you have to be, realizing that we are in a maximum period of uncertainty now. Second thing I wanted to bring up, and on a more positive note, is the Deutsche Bank Research Institute's survey sent out this week, and it's on their website. And so I would encourage everybody to go and have a look at this, called the Long-Term Asset Return Study, the ultimate guide to long-term investing. It's 55, 60 pages. I'm not going to try and summarize it here. We've got far too much of interest to be doing today. This is all for reading while you're sitting down at home by the fire or in your armchair or whatever. This is all the reasons as to why you should want to have equities within your portfolio, because it shows that over 200 years, the real return, so that's the return over and above inflation of equities, is 4.9%. 60-40 portfolios, that's 60% equities, 40% bonds, which is what most wealth managers would recommend you, is just over 4, bonds 2.6, and cash -2.
Wow, the cost of holding
cash. So
the
whole cost of holding cash is enormous over any length of time. As we said before, you can hold it in the short term, but in the long term, you have to get invested if you want to get those returns. It's a really good document. Lots of good things in there for people to learn. And maybe we'll do a podcast on it after Christmas. Maybe we'll get Jim Reed in, who's the guy who wrote it, who's an absolute legend in the investment world here in the UK. But it's just something that I wanted to mention.
Fantastic. I think that takes us time to look at the portfolio then.
I think that's exactly where we should be, because I think we've got to review some action this week. First of all, though, let's have a look at how the portfolio's done. It's been a poor week. We're down 2.6%.
I would just say the board has complete faith in the chairman. Okay, just because people are going to ask the question.
Manager, this isn't. It's like football manager. We have maximum confidence in our chairman
at this time.
But normally it's the manager you have that in. not the chairman, because the chairman is in charge. So watch out. So look, 2.6% down. And if you think about the last 3 weeks, we had a hit to our performance. Then we had a bit of strength last week, but down again. And we are now at the total return level, only up 7.2% since we started, which is clearly disappointing when we were up over 10, but it's actually still a remarkably good performance since we started this portfolio in week 6. So 7.2% in 14 weeks is a pretty good performance. And when we look at where our performance has come from, quite interesting to see that the India performance is up again. When everything else is down, India goes up. It sounds like a very good diversifier of risk within our portfolio. Cash and gilts, not too bad at all. And on the negative side of the ledger, the Van Eck Crypto and Blockchain Fund down another 14%, so only up 6% since inception. The only saving grace for us is we sold half of our holding, if you remember, when it was up 50%. So we'll forget that, as we heard last week, supposedly connoisseurs are better than raiders, but actually in this case, the raider would have done significantly better than the connoisseur. And for those of you who don't know what I'm talking about, go back and look at and listen to the episode last week where we explained those terms and what they mean.
The 5 different behaviors of investors, 3 that you don't want to fall foul of, and 2 which are the perfect roadmap to long-term returns.
So then we've got the Nikkei, which had a dreadful week as well, and that was down 5% in Japan, and the Russell 2000 down 4.3%. And therefore, we've got some hits to our performance there, but overall, we're still looking good as long-term investors.
I think it's actually worth looking at the total return since inception at the moment, because there is staggering differences in the performances of some of the areas. For example, our best performer now is gold, up over 23%. Then we've got copper and the World Mining Trust, all in double digits. So it's really those commodities that have performed for us. Then we've got the Nikkei, despite weakness this week in particular, still up 13. But what about those underperformers? Well, it is the Vanguard FTSE 250, but we put that in as a kind of late entrant. The Russell 2000, another one of our additions, is down 1%. But the S&P 500, for all those that think the S&P 500 is the only thing to ever invest in, we have, since inception, we've only seen a return of 4%. And that tells you the huge difference that you are seeing in the other opportunities that this podcast is designed to highlight, rather than this idea that S&P is the only option out there.
The 2 things we want to talk about in my book, the first one, I've expressed my dissatisfaction with what's happened in the UK. And we have 20% of our holdings in the UK. We have 10% in the FTSE 100 and 10% in the FTSE 250, the smaller companies. I'm not overly worried about our FTSE 100 companies because they're global companies, as Mark will tell us. You know, it's much more about what the global economy is doing. And there's a little bit of protection in them if the currency comes under pressure because of this lack of credibility we've just been talking about, that will help their earnings. So the only one I think that we've got to be a bit concerned about, we did mention this last week for those people who remember back to last week, is the FTSE 250, the smaller companies in the UK. Now, we bought that because we felt that in the budget, she's going to say something about ISAs that's going to be helpful, or maybe stamp duty, or both. I'm still of the view that will happen, but my view has been very seriously damaged by what happened last Friday, and my confidence in that is much lower than it was. I'm not suggesting we should do something about that because we're still waiting for the event next week. It's a very cheap market, so we've got some protection in that. But does anybody disagree with that approach? I'd like to just air out if there's any differences there, then we'll turn on to the other subject I want to talk about.
I think it's very difficult, isn't it? Because big sectors within those mid-250s, like house builders, like gaming companies. So if some of the rumours knocking around that, you know, they might sort of tax gaming and betting more aggressively, that could hurt a big chunk of that sort of sector, which would impact the mid-250. Likewise, if they do anything to damage the housing market, which is already in a very perilous state. I know there was an article out saying that London house prices now 15% now so far this year, which is horrendous because, you know, wealth in London then spreads out to other parts of the country. if they do things that stop the housing market or freeze it, then that could be very damaging. Because in this country, as I've said before, people's pensions are really their houses. And when your house price goes up, you feel better. It's like your own personal balance sheet because people don't save enough in their pensions. So when you're younger, you buy the biggest house you can. You hope you're making money in it. And then you get older, you start to take money out of your house and downsize. And that's just the way the British people do it. So if they do things to damage the housing market, that could be bad for the mid 250 companies as well, because it has lots of knock-on effects to restaurants and everything else that goes with it. So that does worry me, definitely.
I would think that's more unlikely because they've got these house building targets they've got. They want to get people to buy more build more houses. And what they're seeing is that the amount of house prices being built at the moment is much smaller than they would expect. And therefore, I wouldn't think they'll want to damage that much. I think the gambling one is odds on, and our friend here will talk to us about his expectations, but I'd be very surprised if he doesn't think that's going to happen. But I would imagine that's pretty much in the price. So I'm mindful that I'm being a bit wussy, but I just think I'd rather wait to see the budget, given how, there's no optimists in the UK anymore. Everyone thinks that it's a basket case.
The whole of Scotland just turned optimistic.
Of course. And that might help, of course, because they haven't spent money for years. So now it might be nice to see some spending from the Scots.
You buy Wetherspoons.
So I'm going to suggest we stick with it unless people want to actually say no. And then I want to move on to one other subject.
For me, just quickly, we had great news this week from UK inflation coming lower than expected. So the Christmas rate cut is back on.
Definitely true.
In the UK.
Yeah.
So no rate cut in the US, but a rate cut in the UK. So I'm happy to stick with the FTSE 250.
Can I throw one in?
Yeah, please do. Yeah.
So I think gambling companies we've talked about, but what about the impact if there's just a broader increase in dividend tax rate? Will that get capitalized into share prices, or does that not have much of an effect?
My understanding of it, I'm not going to pretend that I am the expert on this subject, is that most of the problem with the dividend tax rate is on people who have their own companies. They're ordinary rate tax holders, and they're only charged 8.5% on that. Whereas most of the people who are getting the benefit of dividend tax are high rate taxpayers already getting 39% tax on those dividends. So my understanding, I might be completely wrong, is that this is something targeted at smaller business owners who are paying themselves via these taxes, whereas not aimed at those shareholders because they're already probably paying these high rates of tax already. It's something that we should probably look into as well. But once again, if she did anything like that, it would be completely contrary to what we were talking about, 3 weeks ago, that the whole point was to try to get the UK economy and the stock market growing again. Doing something like that would be just another example that it's all talk and no follow through in any way, shape or form, which would be another death knell. So I think it's right to bring it up. I don't think it would affect shares particularly because if you remember, Gordon Brown changed the tax rate back in the 1990s, which hurt stocks then and took away the benefit. So the second thing I want to bring up is what Mark mentioned at the start, and that was Nvidia. Nvidia come up with a great set of results. People were worried this week. There was a lot of money come out of the markets. A lot of people were sitting there on tenterhooks. Gosh, if these numbers are bad, this could really be the end of the bubble in technology is going to burst. Blah blah blah. That rubbish, which words we don't believe in. And
Not
suddenly,
anymore,
of course, they come out with great results. Now, on top of that, I think Mark made another good point. That's 2 in an episode. Well done, Mark.
Can I retire?
Yeah. And that is that the interest rate cut in the States has all but been removed for December. One of my views has been that I've been a bit concerned that so many rate cuts have been in the price, and the odds are you're not going to get them all. So they've taken some out. So we've had rate cuts taken out. We've had the speculative top taken out of a number of things you've talked about already, and some great results out of Nvidia. So I think we're all set for that Christmas rally that we've talked about. And because I don't think we should be rabbits, we've got some cash, which we raised a couple of weeks ago out of the German market. And I'm going to suggest that we actually want to put 5% back to work. We can argue about what to buy, but personally, I think if you're going to buy because Nvidia results were good, you might as well buy the S&P 500 as well as anything else.
Or is it the NASDAQ?
But we can argue that, and I'm happy to argue that. But I think we should add 5% to our risk. But I'll leave you guys to give your thoughts and views as to whether we should A or B. If we should, what should we buy?
Yeah, so listening to the conference call last night, completely agree. Nvidia, I think $7 of EPS is now nailed on. And that gives them, straight away $210 to $220 share price. So I'm happy that now the whole concern around data centers and AI build out and the debt surrounding those will be put to bed for a good few months until we get a new negative story or until the market goes too high once more and the speculation returns. So I have been bearish. We've seen all the speculation be taken out. When I do go bullish, then I don't hang around. So I would add 5% of our cash into the NASDAQ 100, and I'd actually take the other 2.5%, and I would buy the crypto and blockchain and innovators ETF, taking us back to a 5% holding in that.
Oh my God, I think we are.
Wow. Sorry.
We've been sitting together for too long.
What have you done with Rich McDonald? Can you let him back in the room, please? Where is he? Now he's eating the bear.
An Ozzy Osbourne moment there. Well, I think one of the interesting things is, of course, November is normally the best month seasonally of the year. It's actually a better month than December is. And so far, this November, until whatever happens today, but until last night, we were having the worst November since the great financial crisis. That's how bad it was so far.
Wow.
Having said that, we're down. S&P was down 3%, right? So it's not the end of the world. And it's been the worst month so far since March. So Santa rally needed to be mentioned, and it has. I'm a great believer that we are now set for a good end to the year. So I'm totally aligned with Rich. I can't hardly believe I'm saying that.
Oh my goodness!
Is that the end of it? Is that the end of the? Is that the true end of the bull market? I don't know, but I actually align with not only his more bullish stance, the fact that froth has been taken out of the market, but also the way I'd allocate it. I would. One of the reasons I didn't want to take VanEck out completely was that I liked to have things in the portfolio as a reminder of, that is there and how well it's doing. Now it's come back sort of 35, 40% from its high. Now is if we're going to get back in, let's get back in. If we're just going to buy another 2.5%, which is what we sold before.
I'd rather buy Bitcoin or Ethereum, but we can't yet. So that is our only option.
Yeah, and as you say, a lot of that VanEck portfolio is data centers and helping to mine Bitcoin, etc. is why we liked it in the first place. So I think I agree with you. I align with that, and I align with you in wanting to buy some more NASDAQ because we did take our NASDAQ down. We halved that. Remember, we had started with a 10% position. We took it down to 5% after a bit of a move higher. So we booked some profits there. Here we are again, another opportunity. And as you say, it's exposed to all the things we like and that is driving markets globally much higher.
Okay, so there's a challenge here. Are we going to buy 7.5% or are we going to buy 5%? And what does it look like in terms of what we're going to buy?
Oh, Mr. Chairman.
Okay, so let's move on. So I think I'm not going to buy 7.5%. I'm going to buy 5%, but I'll do 2.5% NASDAQ and 2.5% VanEck is my choice. I quite like the idea of buying the VanEck, and at least I'm closing a short. Sorry. I'm NASDAQ, S&P, but they're either both going to work or they're neither going to work. So let's buy the NASDAQ and let's just get in there. So we'll do 2.5 of each.
Can I ask?
You may.
Why have we got 2.5% cash? Given, obviously, we've just said that even you got more positive. We've got 2.5% cash. We've got 10% in gilts, short gilts.
Yeah, so no. So to me, I see us having 12.5% in protected assets. And I just want that in case there's something that comes along that I wasn't expecting.
Yeah.
And so to me, I count myself as pretty fully in with where we are. It wouldn't take much, I think, to say, let's put the other 2.5 in at some stage. But I don't need to here. We've got good numbers. I don't need to bet the ranch. We're pretty much betting the ranch anyway. But I'm comfortable with that. But I think 5 is the right answer.
So I'm playing devil's advocate a little bit here. Just if you were a listener and you've heard us worry about the potential budget next week and the impact it's having on gilts, and they see our portfolio and it says short-dated gilts, the gilt might sort of link them into going, well, why aren't you doing anything about that position ahead of a budget? So I would explain it as we've got short-dated gilts, which means they're not as sensitive to potentially a very bad budget affecting the longer-dated bonds, or the cost at which the British government can borrow money longer term, 10, 20, 30 years out. These are sort of 0 to 5 years. So it is less affected by it. And if we're right and that there might be an interest rate cut by the Bank of England in December, that would help. Now, what would you say to that?
I would say really good explanation.
Yes.
Well done. Well done. I mean, in fact, last he's listened to me. It's taken 40 years, but finally he's heard. Your points were exactly right. So the decision we're making, 2.5% back in the Van Eck, 2.5% NASDAQ. Thank you guys for that part.
Get 5% back on your investments. Open a new account and invest a minimum of £50 by the 31st of December and keep at least £50 invested until March. You'll get 5% on your invested value from 21st of November until the 31st of December. Your capital is at risk. New customers only. Offer valid until the 31st of December on ISA, GIA and SIP accounts. Maximum payout £100. Terms and conditions apply. Right, gentlemen, we are now on T-minus 5 days until the long-anticipated budget that has ground the country to a halt, arguably, for the last 2 months. We are very privileged to have the incredibly experienced Adam Smith with us, the namesake, of course, of the godfather of economics. Did that lead you down the economics route in the first place?
No, it didn't. And rather sort of to their shame, I think, my parents didn't actually know who Adam Smith was. So I think they just liked the name. And only when I got a bit older did I think, right, yes, economics could be a career path.
Of course, I wouldn't think it was to anybody's shame because it's only to people who know who economists are. I expect 90% of the people in the country haven't got a clue who Adam Smith is. But the point's well made. In the economist circle, it's shocking. You know, what we really want to do is to get some sort of thought process around, first of all, what happens in the run-up to a budget. What are the meetings like? What sort of conversations are being had? Do you just all get in the room and sort of, you've got a piece of paper marked with every tax rise or tax cuts you could have in, screw them up and flick them in the air and pick the top for the first 5 that come out, or what? What happens?
Well, that is not actually that far away from the truth.
Oh, no!
So, okay, let's go sort of right back to the start of the process, if you like. So the Chancellor will start with their fiscal rules. We hear a lot about those fiscal rules and whether Chancellors need to stick to them or otherwise. But essentially, they are designed to try and provide some sort of market credibility, which we've been talking about. They broadly set the parameters for how much money the government is going to need to borrow. And the Chancellor, this is an important point, not the OBR, the Chancellor decides what those fiscal rules are. And then they commission the Office for Budget Responsibility to provide them with a forecast of the next 5 years, what the economy will look like, what tax receipts will look like, what spending is going to look like, and make an assessment, are you meeting your fiscal rules or not?
And is that an annual report or it's just at the end of the 5 years?
So they lay it out over the next 5 years, but the rule only bites in whichever year the Chancellor chooses.
That's really important. Just a little bit of extra information for our listeners. The Chancellor can decide. So the Chancellor might decide it's in 5 years' time. And of course, you never get 5 years' time because each budget is then another 5 years, and it's another 5 years, and it's another 5 years. So you can keep pushing this out, and our Chancellors have done that in the past.
Yeah, so
I think Jeremy Hunt might have been quite good in that.
He did. So when Jeremy was first,
what are your budgets? Sorry.
Well, first appointed, we needed all the help we could get clearing up for the mini budget mess. But yes, Jeremy changed the fiscal rules so that it was a 5 year rolling one. Actually, to Rachel Reeves' credit, her fiscal rule bites in 29-30, but that is actually fixed.
Yes. So
she is getting closer to her important year. So that was to her credit. So the mechanics of the actual process is you've sort of commissioned the OBR. They come back at various stages with how you're doing. And what the Treasury do is they produce something called the scorecard, which is an enormous spreadsheet, which has every year of the forecast and all the key economic metrics, including one row, which is the fiscal rule row. And underneath that is every single tax change that's being considered, every single spending change that's being considered. What you basically do is in meetings with the Chancellor, they can go along and say, turn that tax change on, turn that one off, put this spending one on, and then everybody watches the row that has the fiscal rule on. And obviously what you want that to do is end up in the green. You inevitably start in the red. And I remember in my case, when I was there, all the initial decisions Jeremy would take would be cutting more taxes than we could do. Yeah. So we'd end up in the red. Yeah. So
can you imagine this? So just you've got all these people sitting around in a room saying, I'll tell you what, let's just change that box and that box. And at that time, there's 1 million people about to suffer from higher taxes or whatever. Oh, let's just muck around with that one. Let's just do that. What a great life. Go on.
It's like the best financial planning sessions you ever have, except you're doing it sort of on behalf of the country. And I think that so the kind of important structural process in that is the OBR. You do hear a lot about what the OBR does or doesn't do, but crucially, they've got 3 roles in a budget process. The first one we've just talked about is that big forecasting piece and are you meeting the fiscal rules? And then they've got 2 costing roles. So what the process works is they do 3 forecasts over about a month that don't have any policy decisions in them at all. They are just the kind of baseline, this is what we think the economy is going to do over the next 5 years. And that is to give the Chancellor the kind of number and then a stable number that they need to hit. Then what happens is the Treasury sends in their first draft of what they'd like to do. And the OBR looks at that and they firstly look at each individual policy. Do they agree that, yes, putting that tax up will raise what the Treasury thinks, or do they think it will raise a bit more, a bit less? And then secondly, they look at what the macroeconomic impact is of all of the different policies. And then they send back a version of that says, well, now that we've got your policies, you are now meeting or not meeting your fiscal rules. And they do 2 rounds of that. So the Chancellor sort of gets 2 goes. They can send their first draft, see what the OBR says, and then they have to send the final set of measures. And so one of the big things that I think people don't quite realize is that all of the big decisions, despite what you read in the media about how it's all going down to the wire, and we used to sort of, to my shame perhaps, brief out that, there were crisis summits about what we were going to do and not do. It was all decided.
Oh, really?
So tomorrow, Friday, so I guess the day this podcast will come out, will be when the OBR sends to the Chancellor their last forecast before the budget itself. So she can't change her mind now. She has decided everything that she's going to do.
So give us an example of something that when you were sitting there around that table, that you looked at that cell, that box, that line, and thought, well, yeah, let's do that. Smacked it in, and then it didn't happen because the numbers just didn't add up. Just give us an example so that people can understand the sort of thing we're talking about.
So I'll give you an example that's sort of possibly the other way round. In the March 23 budget, the big set piece sort of policy in that was the extension of free childcare. That almost didn't happen because on the face of it, it was very expensive. So I think the kind of notional value of it was £6 billion a year, which is an incredibly big spending item. We gave 2 versions of the budget package to the OBR in that first draft. So we sent them one that had the childcare in it and one that didn't.
And you were expecting?
We were expecting them to come back and say, childcare helps a bit around the margins. We're getting people back into work, but it's still net.
It's still a huge cost. We can't afford the cost.
At which point, we'd have had a budget that had very little in.
Yeah.
Thankfully, they came back and said, and actually looking back, it's questionable whether it was quite as good, but I think it has had a good effect. They came back and said it will get so many people back into work, increase the number of hours that people do, that I think they said it would add 100,000 full-time equivalents to the workforce. That 6 billion basically came down to sub $1 billion, at which point, very affordable and flagship measure. So which is what I think has happened this time with Rachel Reeves' decision on income tax. I think she sent her first version, increasing income tax by 2 percentage points and cutting national insurance by 2 percentage points, thinking it would raise, if we believe the media, about £6 billion. And I think the OBR came back and said it won't raise that much. And therefore, given all the political pressures they were under, they decided that it wasn't worth breaching the manifesto for something that only raised a few billion quid.
And why would it not raise as much? Because of the effect on work?
Yeah, so I think the negative consequences of putting up income tax would have had, on people's desire to go into work.
And what are the biggest factors that you can move around? What has the biggest net effect? Is it income tax as the granddaddy?
Income tax is the big one. The big tax levers you can pull are income tax, VAT, national insurance, and then to a lesser extent, corporation tax. So if you do a penny, roughly speaking, a penny on income tax is about £7 billion, £8 billion. A penny on VAT is about 8 billion. A penny on national insurance is about 5 billion, and corporation tax about 4 billion.
We're seeing it from this side. We're seeing that, there's a bunch of young school kids who are mucking around with a spreadsheet, dictating the future of quite a lot of the people in the country, just something they do before breakfast or before lunch or whatever. What about from the market reaction side? You've got these plans, and they go to the OBR, and the OBR say, yeah, they're fantastic, and they hand them back. When does any adult get in the room and say, if you do that, this is the effect that you're going to have on stock market, gilt market, currency? Or do they not really care? Are they immune from thinking about those things because they just don't regard them as important?
So they definitely do care. And obviously I can only talk about my experience of working with Jeremy Hunt. But the chief economist at the Treasury, it is their role, amongst many others, to be the primary point of advice to the Chancellor on what the market reaction is going to be. And they will interact quite regularly with market participants and the dealing firms, and will feed back information.
So you've already made me gulp when you say the chief economist.
Okay, an economist to talk about markets.
This podcast knows what we think about economists. And you're saying it's the chief economist's task to listen to their contacts, who are probably other economists, as to what the effect will be on the market.
Yeah. Well, and I was going to come on to that's the primary source of advice.
Right, okay.
Yeah. You then have the DMO, who is obviously the person who sells gilts, and they will regularly talk to the Chancellor, again, more about how their auctions are going. Are they satisfied with coverage? What do they think the reaction will be? And what, in my experience, the Chancellors tend to be talking to them about then are overall levels of issuance. So, I'm thinking that we're going to borrow roughly this. This will mean your financing remit will go up or down. Do you think that's reasonable? And Jeremy Hunt absolutely would have conversations in the run-up to his fiscal events where he would share with the DMO that overall picture of what he thought borrowing would be, and therefore what that would do to gilt issuance.
Let me just interrupt there for a second, because to a number of people listening to this podcast who are people who have worked with myself and Mark over time, we would ask the same question about the DMO, because the Debt Management Office, once again, the Debt Management Office are the people who issue the gilts on behalf of the government, is not full of practitioners. It's full of civil servants. And so the level of understanding of why somebody buys something and why they sell something isn't something that they know anything about. But they're being asked what their opinion is.
They're being asked on the basics of supply and demand, in that, if you're going to have to sell more of these things, what do your recent auctions say about that? But yes. But there are other avenues as well.
It's right, I think, at this stage that I declare some sort of interest in that a number of years ago, I was encouraged to apply for a very senior job in a government agency responsible for debt. Won't say any more than that. I was told my application was top 3 in terms of the quality and what we've talked about. I was putting a lot of stress on, I bought and sold these things all my life. Surely you need somebody within this organization who knows why people buy and sell to try to help advise the Chancellor on what should happen. I mean, I wrote great. I was really looking forward to my first interview. It never came because I was phoned up the day after they closed the applications to be told that the Treasury had changed their mind, and it was such an important hire, they needed it to be someone who they knew already and not somebody, it wasn't going to be open to the outside world as such.
Well, their losses are gain.
Well, the reason I say that, the reason I say that isn't because, I didn't get even a first interview, let alone anything else. I'm really concerned that people in the civil service are being asked for their views on things they have no expertise in. And this thing last Friday, now I've got to be in my bonnet, I've ranted about it already, and I'll rant again if you don't show me a yellow card in a second. It's somebody should have been able to say, you can't do this. This is stupid. You will destroy all your credibility. And at least then she knows that. She can then decide that she still wants to do it. But I don't know. Maybe she had that conversation with somebody. But I just think it's so important that they understand the effect that they are having on markets. They need some expert with them when they do it.
Just to set us up properly for that, everybody listening to this and watching will be saying, ask him what actually happened behind the curtains during that Truss budget.
The Truss mini budget. Well, so
thankfully, how long have you got?
Well, thankfully, I wasn't there for the mini budget. I was only there for the clear up job. But what basically happened is that for reasons that I think boggle the mind, they decided to ignore the process that I've just outlined and completely ignore the OBR. Actually, they got rid of the Treasury top civil servant who was very well respected almost immediately as they got in, and just decided they would plough on with everything they wanted to do. So in that scorecard process, they were just turning stuff on and not really worrying
about the bottom right number, green or red.
And actually, my view really, when you sort of go back and look at, and everybody forgets the biggest single item of spending they had on there was the energy support package.
Yes,
it wasn't actually cutting the top rate of income tax or whatever else it might have been. I actually think if they had followed this process, the OBR would have probably come back and said, you need to cut some government spending or maybe make that energy support package less generous. And then they probably could have got 75% of what they wanted through the normal system. The lessons there are, you have to go through some sort of process. We can debate whether the OBR is too powerful, not powerful enough, doesn't have the right expertise. You can't just have a free-for-all.
Is there any other times that you know of in history where the OBR have basically been ignored to that extent? If you like, the arrogance of the Chancellor said, well, that doesn't really matter because what I say goes, and markets will fund us whatever.
The OBR, I don't think, has been ignored to that extent. There have been very rare occasions. Actually, we had one in the spring statement where the government of the day has sent one particular policy to the OBR either late or with not enough information. And the OBR has said, we've included this in our numbers, but we aren't able to certify whether that costing is right because either we didn't get the data we needed or whatever it might be. And they publicly say that. So, and the government then just decided to carry on anyway. So they've been sort of ignored. And I think that's happened 2 or 3 times since it was set up in 2010. But it's never been point blank ignored.
And then you just got a phone call from Jeremy Hunt and he said, right, we've got a job to do.
He was appointed on the Friday in October of 2022. And I got the message to say, could you be at the Treasury that afternoon? I had quite one of those ridiculous experiences when he first turned up for work. So I got into Westminster and I was told, actually, he's still in number 10. Can you meet him there? So I went to the gate and, they have, as you would expect, fairly tight security. So I said, my name's Adam Smith. I'm Jeremy Hunt's new advisor. And the guy must have misheard me or something because he said, you're not Jeremy Hunt. Jeremy Hunt's in there. And I said, no, I'm Adam Smith. And he couldn't find me. And I was like, well, this is a great start. And at that point, I got a message to say, no, he's leaving, get to the Treasury. So I scurried round Whitehall and I managed to arrive as he was greeted by the Permanent Secretary. and walked in with him. So it was sort of seamless timing in the end, but a bit of a farcical start to my career as a Treasury advisor.
Was that the same time, and this is a great story, I've seen Jeremy Hunt being interviewed where he says that he was in, now was he in Holland?
He was in Brussels,
He was
I
in
think.
Brussels,
Yeah.
and he got a phone call from someone who claimed to be Liz Truss saying, are you able to come and talk to me? And he thought, this is an absolute joke.
Yeah.
Someone's taken a mickey. There's no way somebody's trying to get hold of me. So he put the phone down and he carried on walking around. And in the end, the Downing Street switchboard on about the 15th occasion said to him, this is the Downing Street switchboard. Would you please hold for Liz Truss? So, all right then. And she said, will you be my Chancellor? And then he had to fly back and do it. But, can you imagine? He thought this is one of those hoaxes, like we're always hearing about somebody getting phoned up, pretending to be someone. It's actually a radio DJ or something.
Yeah.
And he thought that was what was happening to him.
Yeah.
We've got the budget coming up. We've already said that we're concerned about the budget. What do you think they're going to do? What are the big themes that you think they're going to be? And also, what do you think they should do? So you've got two questions.
Well, what I think we should do, I've written about in the Telegraph. So maybe we flip it around a bit.
Okay.
I'll act as the Treasury and the OBR.
Oh, God, so we can play with the spreadsheet. Oh, great.
You guys can play
I've
with
got a big dot
the
there.
spreadsheet. So I think let's assume, which I think will be broadly right, that the OBR's forecast before measures has come back and you've basically got zero headroom. So you're not in the negative, but you're not in the positive. What would you do?
So you're zero. So it's only actually 10 worse than, because the headroom was 10.
Yeah.
So now the headroom is zero. That's very interesting if you think that's the case. So what you're saying is, I think she said that she wants to increase the headroom. So she's going to raise maybe 15 to 20, which will give her that much headroom.
Yeah.
Okay, right. Wow. So who wants to go first? Okay, I'm chairman. I'll go first.
He's been waiting for this his whole life.
Right. Sorry, Chancellor Fellingham. Here we go. So I think first of all, we've got to be sensible on the spending side of the equation. We are spending too much for the size of the economy. We need to do something about our spending. Now, we know that's difficult. Lots of people talk about how easy it is to salami slice things. So, what do I mean by that? I mean that, let's say take 5% off everybody's budget. I have worked in a number of organizations. It is really difficult to do that. And it's not actually the most sensible thing to do in the world. What you should do is start off from nothing and then say, if we were starting from here, what of these things would I have? And what would I not have? Now, I haven't got time to do that today, and you'd probably be asleep if I did. But one of the things that I would do is I'd say, I'm going to look to close one of the departments. I'm going to show I'm in business and close one. I would close the Department of Culture, Media and Sport. I don't know what they do.
Order.
I have no idea what they do, and I don't see why nobody else can do it. The Football Association look after the Football Association, the Rugby Association look after them. I don't see why we need it. That would raise, I think, a certain amount. How much would that raise?
3 or 4, maybe.
3 or 4 billion. So I'm 3 or 4 billion up to start with.
My first job in government was a special advisor at the Department for Culture, Media and Sport.
And that's made my point completely, right? So 3 or 4. That's 3 or 4. The next thing I would do is I would just pick a number and I'd say 10, 12 billion. I'm going to try and save that from the budget. You must be able to do it. It's 500 billion, I think, of spending on a yearly basis. You must be able to make, 12 billion. So let's say 15 billion from spending cuts I'm going to go for. I'm also going to shove income tax up by 2p on everybody. I'm not doing this little bit about, I'm cutting national insurance. I'm putting income tax up by 2p. I'm showing
The first red card of the series, it will be very well cheered.
So I will put income tax up 2p on everybody and say, we've all got to be in this. We've all got to sort out our debt problem. We need to all pull together. And that's why I would do that. The last thing I would do to raise is the triple lock. Now, the triple lock, I'm getting to the age where I will take advantage of it, but I don't think the triple lock is correct in any way, shape or form to be up by the higher of the 3 measures. It's just too generous. I think it could easily be, you could easily say it should move up by inflation. Now, we can argue about RPI inflation or CPI inflation. I'm going to choose CPI because that's what everybody else uses. So I would then say we're going to raise pensions by CPI inflation every year, and that's that. So I've got there, I think, quite a lot of tax raising. How much would I have, my special advisor friend?
I think
What's in the little box on the right?
I think your little green box is very green. I think you've probably raised 40 to 45 billion pounds there.
Right, 40, 45 billion. So what am I going to spend it on? And that's not just me. It'd be nice if it's just me. I would get rid of stamp duty completely on shares and houses. I think one of the real terrible things that was done by, now I've got to remember, it was mainly done, I thought, by George Osborne, but it might have been Brown before him. But it was definitely that sort of era, was bringing in stamp duty on housing. I think when I was young, the housing market built the success of the economy. Because when someone buys and sells houses, you get the turnover going on there. It supports the furniture maker. It supports the painter and decorator. It supports the carpet guy. It just keeps the whole oil of industry moving. And I think it's terrible. I would get it out of shares as well because I want the stock market as high as possible. So first of all, I get rid of stamp duty. How much have I spent?
15 billion?
15 billion. Yep. Great.
Loads left.
Still loads left. So the last thing I would do is I would return capital gains tax to where it was before Rachel Reeves put it up last year. I think you should have capital gains tax. I think that's right. But I do not think that it should be enough to put people off trying to build businesses and drive the country forward. So mine is we're all going to pay something up front here, but I'm putting in measures to get that economy growing, animal spirits moving, get some enthusiasm going, drive the business forward. And I rest my case. I sit down, put my warts down and say, and that's the end of my budget.
Right, the Shadow Chancellor.
Yeah, Shadow Chancellor.
Crikey. How do you follow that one? I too have a view that actually income tax probably needs to go up, but I'd do it in a slightly different way to you. I'd probably put 1p on the basic rate of income tax and 2 pence on the higher rate, because those who have more should pay a little bit more,
Broader shoulders. Those with broader shoulders should pay more.
Absolutely. I'm a caring conservative with a small c.
Yeah.
It is an obvious place to sort of raise some money. And I think people that are realistic about these sort of things. I would also look at things like VAT. I think, that's quite a fair tax. The more you spend, the more you probably should be taxed. And as long as you keep sort of certain areas free of VAT, like children's clothing and some of these other areas, I think are important. But I was looking through this. Well, my kids are out of that now, so I don't care.
Oh, I'm all right, Jack. I'm all right, Jack. Don't think much about you.
But here's the truth. Actually, if VAT had been imposed on me when my kids were at private school, I'd have had to pull them out. I think it's just too much. And, it seems to me that if you're taking your kids out of the public school system or the state school system and you're paying them to go somewhere else, that takes away a huge burden on the state. And you should be potentially rewarded for that.
Chancellor, please focus.
Yeah.
What are your changes, please?
So I was looking through the VAT and I noticed that postal services is not VATable. I asked ChatGPT and I came back with if you were basically to impose 20% VAT on postal services, and I think, by the way, it's such a competitive area of the market now. A few years ago it wasn't, but now you've got so many different couriers. I think it raised about £3 billion. So I'm not sort of going for this sort of huge spending cuts that Chris is doing, and I think that's the obvious thing to me. I'd also abolish duty free. When you're going through the airport, if you're buying booze, you're probably doing it because you want to get, a few sort of cheap drinks before you go out.
Funny old game.
Or you want to smoke yourself silly or whatever you want to do. And I think, sin taxes are probably fair in most cases, apart from maybe alcohol. But I think, again, if you abolish duty free, I don't think it would make any difference, frankly. And I think that raises another couple of 2 or 3 billion quid. So I'm not sort of shooting the lights out here. My main area is I'd want to cut the civil service, and whether you do it in the way Chris is suggesting by cutting out one department, or just saying we need to take 20% out of the headcount, because they're totally sort of inefficient relative to sort of other corporates, the private sector. They seem to be very, very. Every story I hear about people who work in it, etc., would accept that the main civil service, you could do that, and you could, if you took 20% out of what I think, you could raise 6 billion easily out of that. And I think, certain people might think that's too little, but I think it would be a good start. And now to my spending ideas. Well, very simply, I would, like you, I'd abolish stamp duty. I would do that across everything. I think I'd do things to encourage the housing market, because I think the housing market is in a bit of a frozen state at the moment. And I think, as you rightly pointed out, without that beginning to move and without transactions, then the whole economy begins to suffer and suffer quite badly. And I would go back to cutting some of that national insurance that Rachel Reeves put on in the mini budget she did last year, whenever it was, where she added 5% to national insurance. Because a friend of mine who was a builder, he employed 5 people. He got rid of 5 people the day after. He just said, "I'm not doing this," because he was having to pay their national insurance on them and left it to them. That was a very stupid move, in my opinion.
She's never taxed working people, though.
You are getting very close to. You're probably spending almost what you've raised there.
So you see, that's spice for you.
I want to get the economy going.
You aren't getting as good a reaction out of the bond
I don't
markets.
I don't want to be drawing money out of the economy.
You see, I'm a bond guy, so I'm trying to get the bond market reacting well. Spice and equity guy doesn't give a monkey about the bond market.
What's the OBR?
Who are they, Liz? Yeah, can we call you Liz?
I'll be much quicker without the explanations. But this is a budget, all things to know people. So much like my right honourable friend, we're going to remove the red tape, all civil service and planning, and install AI throughout the whole civil service. 2p increase in the high rate of income tax, 1p increase in the base rate. We're going to have an additional 60% millionaire tax on earnings above 1 million a year. We're going to have a wealth tax on properties above 2 million with a special mortgage arrangement with Government Bank for those people who don't have the cash, they can pay it. They are going to get some kind of interest-free loan. Any property owned by a foreign registered trust will be a 3% one-off tax on the purchase price of the property. And I'm going to cut welfare by around 8 billion.
You've got quite a lot of things against the rich and especially rich owners of property. Do you own your own property?
No, I do not.
Funny old game. Sorry to shoot that one down.
Do you think your 60% new tax will actually raise any money?
Most probably not, but it's going to stop those footballers being overpaid for a start.
It's a sort of vindictive style of politics of my Scottish friend.
This may well be what we're seeing next week, so we shouldn't laugh too much.
How am I doing there with the...
So I'm discounting your 60% millionaire thing. I think that raises hundreds of millions, which is basically peanuts. So I think you're probably you've raised 20 billion?
About 20 billion, okay. I am going to increase all nurses, teachers, police and fire service wages by 15% and provide mass training across all those sectors. There's going to be a huge hiring policy for police. We're going to increase funding for the police by billions, and we're going to build new schools and also new prisons. There will be, how much have I got left?
Well, I'm going to say you've got nothing. And you haven't got any slippage either, because you've raised 20. You're meant to keep 15 of that.
Tell me what you'd like to do next, and I'll round your spending down a bit if you...
We're going to restart North Sea drilling and incentivize businesses to drill in the North Sea. And then we're going to cut national insurance by however much I've got left. And then we're going to do away with these silly fiscal rules.
Wouldn't it be best to start with that? I'm doing away with the silly fiscal rules. Now I can do whatever I like.
I mean, it doesn't matter how much.
I think the bond market will really react well to that.
And finally, for
Liz number 2.
These bloody billionaires that say they're going to leave the country, I would charge them an exit tax for the traitors that want to get away from paying tax for the people of this country.
So I think in the socialist utopia that we have just heard there,
can I have the red one?
with no fiscal rules and sort of taxes on wealth that won't raise anything, I think the country is going to the IMF with a begging bowl fairly soon after that budget has been delivered.
Thanks, Rich. That's very kind of you to make that contribution
for the Scottish Nationalist Party.
For the loony lefties of the SNP. Yes. Excellent. So, I hope that shows you how difficult the process is without raising serious amounts of tax to start with, which is what we need to, we're spending so much, we've got to have to do that.
So I think the reason why Rachel Reeves was obviously considering an increase in income tax was because she was being told that she would get a favourable reaction from the bond markets. And I think obviously that is true. So I think what that kind of proves is that chancellors do get that kind of advice, whether it's from sources that we would think are credible or not. But that was a major consideration. The political decision to then abandon that means that she's effectively decided to disregard the fact that this is going to have a negative impact on the bond markets and crack on with what is more politically in the short term expedient for her, rather than what I think we would all agree would be a more sustainable economic package.
I'm going to put you on the spot. What do you think are the sort of 6 things that we are going to see next week, which I'm going to mark you out of when we see what happens on Wednesday?
Excellent. Okay. Well, so I think freezing of income tax thresholds is nailed on to happen. That will probably raise about £8 billion. I think we touched on it earlier, but the Chancellor said gambling companies should pay their fair share in tax. Now, I don't think she meant less tax in that. So gambling taxes are due to go up, and I suspect they'll probably get about £1 billion from that. I think they're also going to cap or possibly even abolish salary sacrifice on pension contributions. That would probably raise £2 to £3 billion. I think dividend tax rates will go up. I think she'll probably increase the bank surcharge. And then she might do something in the inheritance space. So either putting inheritance rates up or ending capital gains forgiveness at death, or even reducing the nil rate residence band in inheritance tax. And then I think a few minor things on electric vehicles seem to be being briefed to the papers as if they're going to happen. So that is the sort of what is now being described as the smorgasbord of tax rises that we will see.
And freezing income tax, you think will bring her in what?
About 8 billion.
About 8.
A year. Yeah.
So you got 8 there, 1 on gambling, 2 on salary sacrifice. So that's now 11.
Yeah.
Bank surcharge, billion.
£500 million.
£500 million.
Same
Inheritance tax?
Couple,
£1 billion. So I'm now up to 13.5. Electric vehicles?
billion.
14.5. And dividend tax?
Gets you probably to 15.
15.
Yeah.
So, and that will be your...
And that will be
that's where you're looking for your headroom.
They will also do what every budget in the past 10 years has done, which is have what they call a tackling the tax gap package of measures, which is a clamp down on tax avoidance and fraud.
Yep.
I looked at the average of what those have raised over the last 10 years, and it seems the average was 6 billion in each package that they announced. So I think she'll probably get 5 out of that, which she might then use to do some giveaways on welfare.
The 2-child cap,
yeah,
and that sort of thing.
So I think she'll end up with that. And if those numbers are more or less right, she might need to throw in a couple of other smaller bits, but she will probably therefore end up with headroom of about 15 billion, I think.
And let's tie this all back to the markets then. If that went through, would the bond market eat it up for breakfast?
Well, I certainly think there'll be more likely to be a negative reaction than actually chosen income tax. And I think the problem that she will have is that lots of those tax rises are backloaded. So I think the real issue she'll have is that people will see straight through the fact that actually in those early years where tax revenues from a lot of those changes don't come in that quickly, gilt issuance over the next couple of years is probably the one to keep an eye on.
I think if she does something like that, she'll sit down, the market will sell off immediately and will sell off more because there's nothing there to encourage the view that we're going to grow any quicker, that we're going to be able to drive the economy forward. There's nothing for the animal spirits brigade in any of that. Why would anybody think we were not still in that doom loop of, we do this, growth slows, we have to do more, growth slows, blah, 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 blah. I don't understand that. So to me, if she does that, that'll be a very disappointing. There's no rabbits out of the hat there. I'm still, call me old-fashioned. I like to be optimistic. You can call me all lots and lots of names next week after the budget. But I still like to think there's something that she's going to bring out the hat to us. Maybe it's something on stamp duty, maybe it's something like that, which is going to make us all feel a bit better. If not, it's a depressing Christmas at the Fellingham household.
Well, I hear Spice clicking away on his computer. Is that you voting for us in the awards?
Oh, yes. Good chance to say. But as you heard earlier on from our chairman, we have been nominated for the best financial podcast at the Good Money Guide Awards. So please, click on the end of show notes and follow the links. It's pretty simple. Even I managed to do it.
Was that the third or fourth time that you voted?
Well, I had to get some more email addresses to obviously do that, to register for it. But yes, vote for the art of investing. Please select as many categories as you think is fair. But we would like you to obviously go for best financial podcast. You can do best financial analyst. Well, obviously that would be Rich. And best investing education. Well, that would obviously be CJ. So you can rate us out of 5. Obviously 5 stars would be fantastic. And any grateful comments would be well received. Thank you very much.
Excellent. So you'll see the hats that we have in front of us. Will we be wearing them this time next week as the budget gives that boost to UK investing? Or shall we be eating them instead?
Well, if the budget is that bad and the pound plummets, FTSE probably will go through 10,000. Yeah. That's a good hedge on that. We have a good hedge.
Wonderful. Give us a like and a subscribe. And if you have a question by email, then send it in to
theartofinvesting@ig.com.
Thanks for joining us. See you next week.